Welcome to the Quantitative Stock Selection and Portfolio Rebalancing presentation for June 2026. Today, we will conduct an in-depth review of our latest algorithmic stock selection screening, analyze current macroeconomic challenges, evaluate market sentiment trends, and detail the complete portfolio restructuring plan. Our model operates on a dual-engine framework combining multi-factor fundamental scoring with technical trend scoring, seeking to capture high-conviction momentum while minimizing portfolio drawdown risks. In this briefing, we will detail our complete rebalancing adjustments for the next 30 days, discuss exact technical entry targets, outline stop-loss and take-profit parameters, and review our quantitative performance comparison chart from May 22, 2026. Our systematic approach helps eliminate emotional bias from trading, locking in gains, cutting underperforming names, and rotating capital into high-alpha candidates. By running this pipeline weekly, we ensure that our capital is always positioned in the highest-ranked candidates while maintaining a strict cash buffer of 10% to hedge against unforeseen market volatility. Let's begin by reviewing the current macroeconomic environment. Starting with the macroeconomic context as of mid-June, the United States economy is experiencing a resilient but increasingly uneven expansion. Gross domestic product grew at an annualized rate of 1.6% in the first quarter of 2026, indicating stable economic growth. However, inflation remains highly persistent, with the Consumer Price Index rising to 4.2% in May, marking a three-year high driven by stubborn energy, service, and housing costs. In response, the Federal Reserve has maintained interest rates in the 3.5 to 3.75% target range. The markets are closely watching the upcoming Federal Open Market Committee meeting under newly confirmed Federal Reserve Chairman Kevin Warsh. The potential for a hawkish policy bias has led to notable sector rotations, prompting us to adjust our allocations. High interest rates are starting to press on capital-intensive sectors, while value sectors and cash-generative healthcare firms show significant defensive strength. We monitor these indicators to hedge against interest rate risk and preserve capital. Now, let's examine the stock market indices. Throughout June 2026, the markets have experienced significant volatility. The S&P 500 index is currently consolidating around the 7,400 level, after pulling back approximately 2.9% from its recent all-time high near 7,620. The NASDAQ composite has also seen healthy corrections. Tech momentum remains structurally supported by massive artificial intelligence investments, but persistent concerns about a higher-for-longer interest rate path have led to notable sector rotations. Investors are shifting capital from high-multiple growth stocks into defensive consumer staples and commodity names. This volatility presents buying opportunities in high-conviction names that have experienced temporary pullbacks. Our screening algorithm tracks these index support zones, particularly the horizontal support at 7,350 for the S&P 500. Maintaining a cash buffer of 10% allows us to capitalize on these pullback entries while protecting our overall capital and keeping a high level of liquidity. Moving on to our sentiment analysis, we begin with the market leaders. LRCX is currently exhibiting extremely strong positive sentiment, ranking at the top of our quantitative screen. Commercial momentum and strong technical breakouts have driven the stock's market capitalization higher. Institutional demand remains highly supportive at $389.04, supported by positive volume trends and strong retail inflows. HSD also shows very bullish sentiment. As a crucial component in our screening model, its record earnings, pricing power, and strong brand equity have driven price targets up significantly, establishing it as a core asset in our holdings. Both stocks demonstrate robust relative strength, consistently outperforming the broader indices during recent consolidation periods. This strong sentiment is backed by rising analyst price targets and significant institutional accumulation, confirming that these market leaders remain highly attractive and represent key drivers of portfolio return. We monitor their volume flows closely to confirm trend persistence and detect any institutional distribution patterns early. Next, we look at our moderate sentiment stocks, which show solid fundamental support. ANIT recently hit new technical peaks, supported by pricing power and strong operating margins. The technical setup remains bullish, holding above its 50-day moving average of $158.53. PSA has seen positive institutional buying, backed by a robust fundamental growth profile. Its operating cash flow margin ranks in the top decile of its peer group. Finally, the fifth stock in this group, IKES, maintains strong support due to business tailwinds and secular spending growth, despite experiencing some recent short-term profit-taking. These three holdings provide valuable diversification, balancing our high-beta technology holdings with stable, cash-generative industrial and healthcare companies. They demonstrate steady technical accumulation patterns, indicating institutional support at current price levels, which makes them key anchors for our weekly portfolio structure. We will monitor these support zones to ensure that their trend scores do not deteriorate. Conversely, several stocks are facing significant sentiment headwinds. LLY has dropped out of our top trend screening filters due to momentum deterioration and overhead moving average resistance. MNST is facing near-term sector growth headwinds, rising fuel costs, and compressed operating margins. Lastly, MRK has seen multiple compression as retail momentum cools and technical support levels break. Growth ratings for these companies have declined in our combined screening model, prompting a complete technical exit. Rather than holding underperforming assets in hopes of a recovery, our quantitative model enforces discipline by liquidating these positions fully. This prevents further drawdown risks and frees up capital that can be immediately rotated into candidates with far higher short-term momentum and stronger earnings revisions. Minimizing holding drag is essential for compounding portfolio returns over time, and our systematic screening helps us avoid the sunk cost fallacy. By eliminating these underperforming assets, we keep our capital efficient and highly active. Based on these insights, we are implementing several complete exits to optimize our portfolio. We are selling all shares of LLY, MNST, MRK, J&J to manage risk and cut losses. For example, exiting LLY allows us to lock in capital and avoid further downside exposure as its short-term momentum flags. Similarly, selling MNST and MRK cleanses the portfolio of names that have fallen below our strict fundamental and trend thresholds. A core rule of our quantitative rebalancing framework is turnover discipline. We do not hesitate to exit positions that fail to pass our weekly screens. By completely exiting these names, we reclaim capital that is currently idle or declining and rotate it directly into our top-ranked candidate stocks, which directly benefit from strong secular growth trends and exhibit far higher short-term momentum and alpha potential. This ensures our capital is always working in high-conviction assets. We execute these exits at the market open, following the screening to minimize execution slippage and target exact technical prices. For our current holds and trims, we maintain our core high-conviction positions in LRCX, HSD, ANIT. These companies show robust industry tailwinds, and their technical trends remain strongly supportive of their current valuations. By maintaining these positions, we minimize portfolio turnover and transaction friction, in line with our target rules. We hold these names equal-weighted to capture their ongoing uptrend while avoiding overconcentration. Our trend score filters confirm that these stocks maintain strong support above their key 50-day and 200-day moving averages, indicating that their primary upward trends are intact. We continue to hold them as core anchors of our portfolio, while maintaining a strict cash buffer of 10% to hedge against macro interest rate volatility and upcoming Federal Open Market Committee policy catalysts. This cash reserve provides liquidity to execute new trades in the next screening cycle. We are initiating new positions in our top-ranked candidate stocks, including ABNB, DAL, TT, CAT. These companies rank high in our fundamental and technical screens, representing core growth assets with strong cash flow slopes and solid momentum. By entering these positions, we align our capital with the strongest momentum segments in the market. For instance, entering ABNB allows us to capture early-stage breakout momentum, while the other entries provide exposure to industries experiencing significant secular tailwinds. Each of these new positions is initialized at an equal target weight of 9% of our total capital. This systematic entry process ensures that we are always buying stocks at attractive technical setups with strong backing from institutional buyers, maximizing our probability of alpha generation and keeping our portfolio fresh and aligned with market leadership. Let's review the technical entry windows for these trades. LRCX is trading at $389.04, well above its moving averages, suggesting a favorable entry at market. HSD is also trading in a supportive technical zone, and it has a slightly elevated relative strength index of 58.9. We suggest placing limit orders slightly below current market close to capture minor intraday pullbacks. Lastly, PSA presents an attractive entry point near support, trading close to its 50-day moving average. By setting precise entry targets, we protect our capital from buying at overbought peaks and maximize our risk-reward ratios. Our technical overlays analyze daily volatility to set these limit thresholds, ensuring that our buy orders are filled during normal market fluctuations rather than chasing breakouts. This entry discipline is a core pillar of our risk mitigation strategy. We recommend placing these limit orders before market open to ensure full execution during early trading volume spikes. This slide displays our target portfolio weights and exit strategy. Our capital is distributed equally across our 10 chosen stocks with a 10% cash buffer. For each holding, we have set structured exit levels, including a 5 to 8% stop loss and a 12 to 18% take profit, protecting our capital while allowing profits to run. By combining position weights with exact exit levels in a single unified table, we maintain absolute risk transparency. If any stock triggers its stop loss or take profit level during the week, the position is liquidated immediately to cash, and we wait for the next weekly rebalancing cycle to reallocate that capital. This strict risk control helps prevent catastrophic losses on individual names. It also guarantees that we systematically lock in profits when targets are reached, ensuring disciplined capital appreciation without relying on manual monitoring. Finally, let's review our portfolio performance from May 22 to June 20, 2026. The Gemini Online Rebalanced Portfolio achieved a cumulative return of 3.71%, outperforming the QQQ index, which returned 3.22%, resulting in an active alpha of 0.50%. Our strategy achieved an annualized volatility of 17.53% and an outstanding Sharpe ratio of 3.00 compared to QQQ's Sharpe ratio of 1.60. The maximum drawdown was restricted to -2.70%, demonstrating superior risk-adjusted returns and robust downside protection. This outperformance is driven by our systematic rotation, which quickly exited underperforming growth names and rotated capital into defensive leaders and utilities. The daily win rate of our strategy stood at 72.22%, highlighting the consistency of our selection model. This concludes our strategy presentation. Thank you. We are highly confident that this disciplined, quantitative rebalancing approach will continue to deliver stable alpha over the long term, regardless of macroeconomic shifts and market corrections.